All right, welcome to the Altus State of the Market call. We have a very exciting panel discussion today where we'll get to hear from industry leaders at a fascinating time in the macro and market cycle. 2022 was a year to remember, even though many of us would probably want to forget. And the year started with tremendous momentum carried over from the booming year that was 2021. However, US and global monetary policy tightening, plus devastating conflict in Ukraine and lockdown in China really shifted and brought a chill to market expectations. And that chilling effect spread throughout capital markets. The yield on the 10-year Treasury went from 1.7 to 4.2 before settling at 3.8%. Broad equity indices lost about a fifth during the year, and M&A activity slowed dramatically. As a result, outlooks for the periods ahead really began to focus on recession risk. CRE markets were also affected as the cost of financing increased and lenders pulled back in a significant way. Transaction activity slowed and price discovery became challenged. And this is all despite many underlying fundamentals that remained intact. Now, while 2023 is a new year, many of the questions that arose during 2022 remain. And to discuss many of these lingering questions today, we have an amazing panel of guests who I would like to introduce while we launch a quick audience poll. Joining us today on our panel, we have Sarah Queen, Leslie Lisser, and Robbie Tangent. Sarah Queen is head of equity strategies for MetLife Investment Management's real estate group. Prior to joining MetLife in 2021, Sarah held leadership roles at Mapletree Investments, Brookfield Property Partners, and Clarion. Leslie Lisser joined Invesco Real Estate in June 2012 and is currently a senior director in asset management, overseeing approximately 5,000 units ranging from luxury to affordable in New York and the tri-state area up to Boston. Prior to her current appointment, Leslie held leading roles in asset management positions at Lehman Brothers Holdings, Wafra Investment Advisory Group, and MS Asset Management. Robbie Tangent is the global head of business advisory services here at Altus, where, among other responsibilities, he oversees the valuation of a majority of large institutional open-ended funds. Thank you all for joining today. Finally, I'm Omar Altarai, Director of Research here at Altus, where I help to identify, explore, and analyze trends across the CRE market, leveraging Altus data and internal insights. Now, before we kick off the conversation with our panelists, I'll turn it over to Michael Claywar, who will help tee up the conversation with our esteemed panelists by providing some context on what he's seen in the market data as we head into 2023. Michael is a vice president and head of data and analytics at Altus Group, and his remit includes oversight of the Altus Labs, which is focused on identifying new opportunities within innovative sectors of the PropTech ecosystem to help address customer needs with data-driven intelligence solutions. And with that, Michael, I'll give you the proverbial floor.
Great, thank you. And so with the great panel of folks following this portion, I think what we wanted to do was focus on the 5 key questions that we're watching for this year that we see are going to shape the commercial real estate market in 2023. So question number 1, macro trend across the US, is the Sun Belt going to continue to dominate macro growth? And short answer is broadly yes. Through 2022, these markets have continued to dominate migration flows. So as we look at mobile phone based estimates of where people are moving, they're leaving New York City area, they're leaving Chicago, they're leaving California, and still moving into Phoenix and Austin and Florida and the Carolinas. There's really no evidence in our data for the last quarter or the last half of the year that this trend has slowed down compared to 2021 or the start of 2022. And you can see in other sources like U-Haul's 2022 report that these are kind of the top markets that are attracting folks in 2022. And it also is backed up by employment growth. So not just 2022 was a great year for employment growth, but throughout the entire kind of pre-COVID through the COVID era, so past 36 months, 2019 through November of last year, typically the markets that have seen the strongest population growth or net migration have been those that have been adding jobs at pretty significant rates. So Florida, Central Florida in particular, Austin, Phoenix, you can see kind of different types of employment patterns throughout the Midwest. So we're not really seeing any significant weakening in the national employment market. Job openings have perhaps ticked up a little bit. We're still adding roughly 200,000 or more jobs per month. Continuing claims have ticked up a bit, but they're still low. So there's not really anything to suggest in the labor market right now that things are really weakening. And we'll touch on wages in a little bit. The second question, are household counts going to remain above pre-COVID? So this is a big question for multifamily for next year and for single family. During COVID, we saw folks move out, decreasing in household size, fewer roommates, trying to get more space, moving into the suburbs, and all of that pattern and discussion that we heard last year and the year before. We're still above the pre-COVID trend from 2015 through 2019 in terms of household formation, somewhere around 500,000 to 1 million extra households than we would have expected before COVID. So the question here is this going to hold up? And I think the answer here is a bit mixed. We're really seeing that growth potentially slow down in the past few months based on the Census Bureau data we track. But what this has really done last year was give a huge shift to pricing power for multifamily operators, where we've seen clients who are able to raise rents by 35% because they could get a lot more aggressive on pricing. Kind of the other side of the picture is the supply, right? So we see demand potentially coming back down. We're also seeing that multifamily household construction pipeline measured by starts is the highest sustained level it's been since the 1980s. This is going to put a lot of pressure on rent growth as these turn into completions. And many markets, specifically some of the hottest markets in the Sun Belt, are still showing really high permitted construction levels. So whether these turn into starts is another question, but we've found in our models based on our asset level data that typically if you increase the population adjusted permit rate here on this chart by 1 unit, you're going to see a 1 to 2% annual decline in multifamily asset level NOI. So pretty significant drops, and you can see changes of 4 or 5 units for markets like Atlanta or Travis County, which is Austin, or Wake County and Raleigh, and you can kind of see that playing out already in on the rent growth side. Third question, how sticky is compensation growth going to remain, and wage growth specifically? We're seeing potentially a peak here, but this is going to be probably the major driver among all of them for Fed decisions next year, with rents potentially rolling over. We're seeing that compensation growth is double the pre-COVID level as measured by the employment cost index for total compensation at a total level for private industry workers and for tech specifically, maybe a slightly smaller increase, but we're still running at 4.5% to 5% year over year or annualized quarterly growth. However you spin it, it still is much too high to get back to that 2% inflation target. So there's a lot of pressure on the Fed and how they're looking at it from this chart specifically. Brings us to question number 4 of 5. What scale of risks is higher for longer going to expose for existing debt? If we look at the Fed dot plots, they started a message in December and they've tried through the second half of last year. We're going to stay higher for longer. You see a shift from September to December, September being the pink and December being the blue-green. For 2023, their expectations of appropriate Fed funds rates to end the year shifted up about 50 basis points. Similar kind of shift in 2024 before they move back to similar longer run neutral interest rates of about 2.5% for the Fed funds rate. Market's not really pricing that in at all. They're pricing in lower and sooner. 2023 ending 100 basis points based on Fed funds futures and the Atlanta Fed's market probability tracker. So 2023 is lower, 2024 is lower, and 2025 kind of getting towards that longer run rate is lower. So this is going to really play out in who's going to be right over the course of 2023 and beyond. And why does that matter for real estate? One way it matters is that we're seeing that CMBS portfolios or loans that are maturing in 2023 are going to face a dramatically higher rate environment. So if we look at fixed rate CMBSs that are maturing in 2023, they're anywhere from 30 to 190 basis points lower on the interest rates on the coupons compared to loans that were recorded in 2022 Q4. So it's a huge risk for those loans. Typically about 10 to 15% of loans maturing in the next 1 to 2 years, in addition to loans that have variable rates. All of those are potentially going to come under pressure. And you've already seen in the last few weeks some pretty big 500 million to $1 billion portfolios that are coming under pressure, having to restructure or potentially walking away from the assets. And number 5, how are cap rates going to shift as transaction volume takes a breather, as Omar mentioned up top? We're seeing in our transaction data that the square footage that's been traded across all of the 4 major food groups has really come back to pre-COVID levels after kind of cratering during 2020 and then really ramping up in 2021 and early 2022. We're kind of coming back to what we might consider normal levels, not necessarily for prices, but for the volume of square footage that's trading. And according to some of our survey results from the end of 2022, what people think in the market, and we're expecting somewhere 25 to 75 basis points increase in cap rates for a lot of different property types, office being the exception from the folks that we surveyed, who are expecting 75 to over 100 basis points increase. So I know we covered a lot there. With that, I'm actually going to pass it back over to Omar. I'm sure excellent folks here will provide a lot more color and detail from their experience and potentially go in some other different directions.
Thank you very much, Michael. Really a lot to consider, but an excellent overview of many of the questions that I hope we can touch on at least a few of them today. And we'll open it up to the panel here. I guess one of the first questions, and I guess the last question that Michael presented, but the first question that I'll pose here, Robbie, I'm going to pick on you because this is an Altus call. I know that a number of our the attendees in the audience who have tuned in, I'm sure are wanting to hear a bit from Altus, specifically on I would say the values that we've seen recently and some of the trends. 2022 really did bring I would say many things, but especially a divergence of views, particularly when it comes to CRE values. So what are the valuation trends that you've seen over the last quarter? And can you speak to the divergence of public and private valuations?
Yeah, thanks, Omar. I mean, I think that the overall, the return is not out yet, right? So the fourth quarter return is coming out in the next couple of weeks. So I'm going to connect a little bit high level. What happened in 4Q? Everybody want to know that, right? So I think you see industrial as what Michael showed as pricing movement, right? So it's kind of expected. So pricing movement already started in 3Q. So you see more pricing movement, 25 to 50 basis point on industrial. Cash flow still strong, although reducing from the previous quarter. So there's definitely going to be more negative, right? So a negative kind of appreciation side. I think you're going to see that the same as apartment. 25 to 50 as well, more on the pricing side. A lot of them more closer to 25, right? As kind of we showed, the delta on the financing side is still there, right? So Freddie Fannie relatively cheaper compared to other property type overall, right? So, but cash flow side is still a big question, right? So as we kind of indicated, is it the first time for a while now we've never seen a basic seasonality? Seasonality start coming up. The question is it seasonality or is it slowing down associated to the supply chart earlier, right? So I think that's something over the next couple of quarters we're going to see whether it's really slowing down or is it still the Sun Belt migration is still strong, eventually still picking up. I think that's the battle of that two, right? So it's a pulling kind of which one's winning later on. So I think the office is going to be the worst one. Everybody know that, right? So there's always a big question. So you're going to see a lot of pricing adjustment there, right? So 50 basis point plus in fourth quarter, plus cash flow, right? So people are going to start looking at basically, yeah, we always assume there's some stabilized occupancy, right? So that stabilized occupancy is getting lower and lower, right? So it's a little bit like I look at it, office is similar to, office is the new mall, right? So as we kind of go mall previously, we don't know what the stabilized occupancy will be. That's what we're kind of going through. There's still going to be a lot of question marks. And retail at the end is the best sector type relatively. Still negative, but they've been hit significantly right over the past 2-3 years. So that's going to be kind of in a sense negative, but better than the other sector. I think that the overall as well, we could talk about private versus public. I think that there's a lot of negative news about private real estate. But in reality of it, right? So private real estate are traded based on NAV, right? So public are share, right? So, and the NAV is basically a lot of people estimate, right? So they can, and people say public is always right, but some article indicate public sector tend to overshoot. So who's right, right? So, and I look at it basically that on the private real estate, people have to understand there's a lot of people involved. It's not just an appraisal, it's not just comp, right? So valuation are done on the DCF basis, right? So basically we incorporate factual, we incorporate operating statement, we incorporate budget, right? So that's all done by the clients managing the asset, right? So, and on top of that, we forecasting supply and demand side, like just what we showed earlier. That's part of that 10-year forecast, right? So, and to get to the value, we have to go comps. Com is one data point out of all this part, right? So financing, also one data point out of this part. And on the com side, the deal that closed, the deal that does not close is part of the data point, right? So when the news always indicate, it's always based on com, so therefore it's lag. It's like, guys, there's a lot of discussion going in here. Everybody's putting a lot of effort going into here. There's a lot of check and balances, Altus, third party, client, research, portfolio, asset, and auditors, right? So I think that the one thing that I think the market people doesn't understand is to get to the value, there's a lot of check balances, there's a lot of effort getting to it. And yes, people might argue that the value did not go down, just like housing market today, right? You can argue interest rate go up. Why the housing market didn't immediately react, right? Same as the private real estate. So, and the way I look at it is like, guys, private real estate, you know, there's a lot of people putting on it, client, portfolio, asset manager. They're working hard to get to the basically managing the cash flow, managing the asset, right? So when you're investing into private real estate, there's a lot of transparency, there's a lot of effort to get to that NAV, right? So there's differences of public versus private. So I'm standing up for private, right? So as you can see in here, I think the news is a little bit too much saying that private is all wrong. I think that that has differences, right? So.
Yeah, and I'm sure this is going to be a conversation that continues for a while to go. But I guess, Sarah, Leslie, we did invite you here because we do want to hear your opinions. And I guess to open it up to you, how would you characterize the current market environment, and what are some of the themes that you're watching in the year ahead? And Sarah, I'll start with you.
Look, there's no easy way to characterize it. It's a tough market. We all know that. I've been doing this for a long time, and this is one of the toughest markets. Now, you know, we have the GFC. That obviously was an extremely tough environment, but you could still get lending dollars. One of the things that has made this market so tough is with the refis. You know, your slide talked about the amount of CMBS that's coming back and the rate dislocation. But what it didn't talk about was loan to values. And one of the things that we have seen is because values are going down and the uncertainty in the market, you know, lenders are asking for pay downs that, you know, prior markets you wouldn't necessarily have seen and wouldn't have seen to that extent. And if you don't have a relationship with a lender, it is very tough to get new financings these days. And so that is putting a chill on the acquisitions market. So it's a combination of things that are occurring this time. Not to mention coming off the heel of COVID, you know, there's some big systemic issues going on. You know, how do people use office? You know, how often are people going to be in? How closely do you want to sit to each other? These are all things that have to continue to play out. And then you layer on this added complication, it's just brought a lot of uncertainty to one of the largest asset classes.
Thank you. Yes. And Leslie, is there anything you would like to add?
Well, just to add on the multi-family underwriting, you know, looking at new deals right now, you know, nothing is penciling out. Template rent growth for the first time, I'm increasing operating expenses 5%. Obviously, the numbers are not shaking out. So just to echo what we heard before, you know, we are still discovering pricing, and I don't know how long it's going to take for that acknowledgement or clarity in the market right now, but it surely isn't here.
Yeah. And one of the challenges with the current time that I've seen, and I'm sure others, and I've actually heard from other folks across the industry, is that there really aren't great historical periods to compare to, right? There are certain elements in the current market environment that make this time different, and pairing that with the fact that more and more, whether it's on the business side or in academia, but more and more economists, and I believe the market is starting to factor in kind of some sort of pullback, or really the R word, recession, in the next 12 months. I saw a Wall Street Journal article just in their survey noted that it's a 61% probability in the next 12 months. This is something that, you know, I like to think that the economy does go through recessions, but it tends to make it through. And the CRE industry as a whole also makes it through. However, how it gets through that period can be pretty dramatically different. So I guess, are there periods in history that the current period you think kind of rhymes with, or that you see similarities with? And Leslie, I'll give you the first answer here.
Well, I was trying to look at it again from asset management perspective, you know, starting my career in RTC days, where we bought pools of loans and converted them to owned real estate. You know, we were able to buy them for under $100 a square foot. So, you know, it talks to the theme of pricing reality. This allowed us to put a lot of capital to these buildings to reposition them, build out pre-builts, redo lobbies, all these things. I'm seeing a little bit of that similarity in New York right now with the haves and have-nots of real estate. You read about the haves buildings putting in tons of capital to create amenity floors, lounges, gyms. This is the first time I'm really seeing this, especially in New York City. So I think that's a little bit of a comparison. Fast forward to when I was at Lehman and the global financial crisis. You know, there we still put money into real estate that we believed in, that would stand the test of time, and that made sense. But again, the ones that we wanted to get rid of, there was a price realization, acknowledgement that we had to lower those prices in order to transact. And we basically came up with numbers that really solved on all the costs that it took to redevelop, lease, carry time. It could be 1 to 2 to 3 years. And then we came up with a price that we were able to transact at. So these are how I'm trying to wrap my arms from an asset management perspective around this cycle.
That makes sense. And Sarah?
Look, I think to Leslie's point, buildings where you have a strong fundamental, you absolutely need to be investing in your buildings to keep them current with what tenants are looking for and invest in those. The issue to the haves and have-nots, particularly in New York City, is what we're seeing is that newer construction is the haves, and it is getting record rents, even on the office side is today. But there's a whole host of buildings, many that were built, you know, pre-2000, that are just not able to attract tenants the way they used to be. And I think the trillion-dollar question is going to be, how much money should you be spending on those buildings to lease up, and who are the tenants going to be? The tech companies have been laying off. Now, if you look at how much they hired going into the pandemic, they are still way net hirers from where they were in 19. But if they're either reducing their square footage per person or allowing people to work from home, they may not need the same footprint. So how do we navigate through that? Some of them also overtook space because they were concerned they weren't able to get the space they wanted, and so now they put space in the sublease market, so we have to work through that. But there are other firms that are sitting in a 1980s office building, and they're trying to decide what should they do, and it'll be interesting to see how that plays out. I think, Leslie, when we were both, early in our careers, was the point that, former Mayor Giuliani did the, conversion play of old office buildings in downtown into apartments. You're seeing that trend we talked about again. They make for very awkward multi-family buildings. You know a lot more about that than I do. But, there are some things that we need to really think about. How are we going to use our building stock? And it's not so easy just to tear one of those buildings down and start over, even though that would build a much better building. We also have to think about the embedded carbon in those buildings, which is humongous. There's some real issues that have to be thought through as we figure out where we're going to deploy capital and what makes the most sense in the long run.
Thank you. And one of the big, I think, themes that plagued 2022 was really the cost and availability of financing, right? So the rising cost plus declining availability really was a massive headwind for the entire industry, and remains so. Now, while the yield on the 10-year Treasury has come down nearly 80 basis points since it peaked in October, it is still elevated compared to levels seen over the last decade. And recent Fed commentary has really all but ensured that either more hikes are on the way, or at least no cuts are in store for a while longer. Regarding financing trends that you're seeing in 2023, or you may have expectations for, are we waiting for rates to stabilize or come down, or are there new structures that may pop up? Sarah, is this something you'd be able to comment on?
Sure. So, lots of times you can't wait, right? Like you waited for things to stabilize, and now you just need to make a decision. If your team has been doing a good job, you've been well aware of what you have to do to get your extension by right, and you have done whatever that is to be able to exercise that. If not, you are relying on the fact that hopefully you have a good relationship with the lender. Maybe you are shifting over them so they can hold more of your corporate cash, or establish some other larger relationships with them, because you need a relationship lender at this point. The other thing that we see is, look, there's lots of times where you are hearing from the banks, we will lend to you, we will extend to you, but you need to do a pay down because, your LTV is out of that. And so, we may all disagree on what that value is, but ultimately you're going to have to come to an agreement with them. And so then I've been thinking about, so what other structures can be in place? Fortunately, as a large institutional investor, we're usually in a position where, the capital is not as much of an issue for us as it is for some others. We've also been looking at structures where we do preferred equity. Sometimes, with clients, sometimes, looking at other structures. But I think, we are not the only ones who are out there doing preferred equity. I'm sure Leslie can go through a long list of people who call her up that are happy to do preferred equity on multifamily deals all day long. And so, people, I think, are spending a lot of time trying to think about what things can they do to help bridge that gap. And, you know, is it true preferred equity? Is it just in the partnership agreement, you know, rejiggering the waterfall so that somebody has priority capital? I mean, there's, you know, there's mezz debt, there's all sorts of things, and I'm sure that there will be whole new structures that come out of this. Now, you know, 5 years later, those structures may blow up, so some of those may become the way we do things on a going forward basis. You know, we've all talked about that these are the periods where you see innovation in the industry, and it's also really important to concentrate on your fundamentals in the sense of making sure you have the ability to do an extension within your existing documents, making sure you have nailed the things that you have to do to get that extension.
That makes sense. And I guess I'll open it to the other panelists. Does anybody have anything else that they would like to add in terms of cost and availability of financing trends?
Well, I'd just like to say that I know our debt teams are working with all of our sponsors and making sure we're working on those relationships. That's paramount right now, as Sarah said, to have those strong relationships. But I just have to think about my Lehman days where I saw a lot of structures and mezz levels and preferred equity levels, and they didn't work. It still all goes back to the real estate, the NOI, how much money you're making, how much money you're spending, and, you know, really look at the underwriting. And I know our teams are doing thorough looks at what the fundamentals are of the real estate that we own or are part of.
Perfect. And actually, following that thread and shifting a little bit more attention to the operating cash flows and the fundamentals, Robbie, would you be able to speak to, you know, some of the trends that you've seen across either property types and markets at the, you know, whether it's sector level, but specifically around, I guess, cash flows and fundamentals?
Sure. I think that if you look at the last 3 years, right? I mean, like the overall kind of do I look at on the fund performance side, there's a lot of cases associated to allocation, right? So the last 3 years, 60 to 70% of fund performance is more to allocation, less about selection, i.e. managing the cash flow, managing the asset, right? So as that differences now, basically industrial, everything going down, that differences become less. Guess what? Over the near term, it's much more about, we'll be back to what I call it more selection, right? So historically, about 60, 70% selection, 30% allocation, right? So therefore, I look at it, the cash flow will become more important part, right? So I'm going to do a shameless plug, right? So join us February 7, right? We're going to dissect more fourth quarter return on Odyssey. We're going to talk about cash flow and return, right? So, but, and the other thing as well, like in each one of them, as I elaborate a little bit, right? So industrial, generally people feel still pretty strong, right? So the rent's still going up. If you look at even the REIT perspective, everything is still seeing a positive leasing rate, right? So even though with the slowdown Amazon, they're still the vacancy is still pretty tight, right? So with construction costs still high, it's going to limit the new construction in the future. So I think that the industrial still people feel comfortable, and I start seeing more and more transaction in industrial as well. So there's several deals on the West Coast that people acquire at like sub 4 cap rate for 2022 year build, right? So a low 4 cap rate, which means they're willing to take a negative leverage for a long period of time for that asset because they feel comfortable for that asset, right? So apartment is still kind of, do I look at it? Still a little bit clarity needed, right? So expenses are a big issue, right? So costs still up, property taxes still going to be up, insurance still higher, right? So that's still impacting on the multifamily front. Overall, people still pretty positive generally on the basically on the multifamily side. And then the one that a lot of what we see in a lot of new fund created, it tend to be affordable housing. So which means, again, it's a big issue in the United States, right? Affordable housing. So there's going to be someone's going to put more capital into the ESG aspect to it. So I think that multifamily is still relatively pretty good footing, right? So office, that's the big question mark. So like, yes, contractually, you look at every REITs out there, the cash collection is still pretty strong. But what happened when the lease expired? I don't think anybody really know the answer to that yet. And I think that the good asset are still leased pretty well, like one Vanderbilt, all the rent people talking about 150, 200 bucks per square foot, which is Definitely, right? So on the other hand, the commodity office might not be. So retail, you still get pretty strong cash flow, right? Generally, they kind of bottom up already, and then you see more traffic in the mall, right? So grocery are doing pretty good. I go grocery now, you look at the egg prices that like used to be 99 cents, now it's $5. Guess what? The sales is up, right? So on the grocery side. So I mean, usually the grocery, the sales, the rent are tied to the sales, right? Occupancy cost ratio. Yes, when the sales up, your rent can be kind of higher. So the retail still look pretty strong fundamentally. Everybody in all of the sectors still have a question mark, right? So everything tied to the economy anyway, right? I think that's the uncertainty still there, but there's still a lot of positivity to the U.S. economy overall.
Perfect. Oh, sorry. Yeah, I was going to open it up. Yeah.
Sorry, but one of the things I think that is also happening on the industrial side, you're talking about buying at a low cap rate and you're taking a negative return. But I think the one thing that happens with industrial, right, is it's a lower total outlay. And so I think for institutional investors, what you're seeing is people buying all cash and assuming that in 2 years, they'll be able to refi back to something more normalized, right? And so they'll take the lower return now on an all equity basis and then refi out in time. That would be my guess.
Agree. Yeah, I think that that's one thing on private real estate that people always look at it. Hey, today market financing is 6, so your value should be up. In private real estate, you have the ability to do exactly what you indicated, Sarah. So that's kind of part of the equation when valuation of private real estate is a little bit more longer term rather than every single second financing is up, therefore the pricing go down, right? It's just like a public market. I think people tend to use public saying that it has to be that way. May not be, right? There's many reasons associated with it as well.
And Sarah, I guess actually as a quick follow-up with that, does that shorten the timeline in terms of like the investment timeline, or is it just a shifting kind of like the how deals are financed if the planned hold time is still longer than the time period that they're planning on doing the recapitalization? Or is that, I guess, that approach shifting the whole kind of like thesis to hold for a shorter period?
I think it's really a case by case basis. I mean, if you're transacting today, there's a reason you're really attracted to that asset, right? Because it's easier to sit on the sideline, and for particularly a lot of the institutional investors, they've had a denominator effect issue, and so they're out of balance on their real estate. So you may be either solving a problem for them to getting back to your allocation. How much is it selection and how much is it allocation? Some of them are still under allocated into, say, industrial. And so they may be willing to stretch on that industrial deal because it's filling an allocation bucket for them. Others don't have that issue, or they're like, hey, if I'm going to take my industrial, I'd rather go into the big public REITs. Their pricing is down too. It's an easy way to access without actually having to go through the market. But, so you can structure different ways, but the buying all cash doesn't necessarily mean you're either going to sell it quicker or hold it longer than you would have otherwise.
Okay, thank you. And Leslie, I guess going back to the original question, which is trends in operating metrics and cash flows. What are you seeing in terms of the multifamily portfolio that you manage?
Well, multifamily and also looking at the other sectors too, we are leaning on technologies to help lower expenses. So whether or not they're from energy savings with enhanced BMS systems or thermostat controls, leak detection, other things that are going to offset potential costs that could really hurt your NOI. Another thing and that could go across all asset classes, obviously. Another thing we're looking at is payroll, and payroll is a big thing in multifamily, and we're looking to go more automated with self-guided tours and with keyless entry systems, and also other AI technologies that would help with scheduling and alleviate a person. So the goal is really to eliminate payroll because there's not that many other levers we can pull right now to offset the tepid rent growth that we're seeing.
Well, and I think the other thing, Leslie, is we've all been operating short staff, right? Like it's not been easy to hire for a lot of those jobs, and so I think
and hire, and then you have to replace very quickly also.
Yeah,
Yeah.
So I think we've all been figuring out how to operate buildings with less and looking for systems to help us be able to continue to do that, but do it at a way that you're still operating the building at first class level. And so, I think, we're all using technology and other things, but it's also necessity is the mother of invention, right? So, we've all been short-staffed, and that is driving some of those innovations.
Absolutely. And help, drive up NOI the best that we can too.
Yeah.
And hopefully I guess the period at which the return on the investment is, hopefully those timelines are shortening. But I don't know if that, if anybody has thoughts on that, but because I know that, the tech investment can take a while.
Good ROI on, the energy savings programs, you can do that. We're not fully there with the Payroll yet. We do partner with Avalon is one of our major partners, and we're seeing what we can do to lower staff, but it's a process that takes time, and we're not quite there yet, realizing the savings. But the energy should have, 1 to 2 year payback, and we're seeing that.
All right, and I guess shifting over to potential catalysts that could change markets and market conditions material in the next year. In our prep call, Leslie, you had noted a number of regulatory changes or recent shifts in, at least in the New York government plans. Would you like to touch on those?
Sure. I mean, a great insight from ULI in New York, as well as the Garment Center bid. So, it's exciting. I think it's been out there in the papers that the mayor is proposing adding 20,000 units by converting obsolete office buildings, by changing outdated zoning and other regulations. This all needs to be offset by financial incentives, which I think are in the works. That's the only way it's going to work. And also, areas to focus on naturally by living in New York. You look at the Garment Center, you look at areas downtown. But as Sarah said, it's going to be very difficult. Not every building can convert so easily. There's some success stories downtown that I've definitely toured and seen, but a lot require, building, putting in cores in the buildings, and you're really taking them apart, and it's extensive work. So without some real incentives to get this done, and we could add more affordable housing with it. I think that's part of the program as well. But without that backing between, government and private public markets, it's not going to work. Another thing that I am thinking about too is Local Law 97, because that's definitely something we have to think about in New York, and it's expensive, and not all buildings are able to meet those requirements without spending a lot of money, and really not really feasible. So I am concerned about that and how that will impact just overall investing in New York, besides all the other challenges that we're having in the office environment.
And Sarah, are there any catalysts that you're watching?
Everything. I think, like, as a New Yorker, I feel very strongly that we need to fix the housing crisis. And as a real estate person, I look at a bunch of, very low occupancy office buildings that are like, we need to figure out how to get people living in this, but they won't be great units. And so, I mean, some of the conversions have been quite lovely, let me say that, but it takes a certain kind of building, and maybe I haven't done enough of a deep dive as I should, but my supposition is that the buildings that are easier to convert have been converted. So what you're left with is somebody needing to be very creative or needing, big incentives to get there. One of the things I do spend some time worrying about is, we have a bunch of cities that have taken more proactive change that push on climate. Along, be it New York, DC, Boston, some of the others, but we have a lot of cities that are not addressing this. You see in the headlines, every day, some new weather-related crisis, and we need more of a national response, not that I'm a big regulation person, but I think that, one of the problems that you're getting to is you can build something that doesn't have to deal with climate change in some of the cities that basically really needs to be dealing with climate change. And so these are the questions that institutional investors are going to have to be asking themselves in the long run. Are those the markets that we know the population is growing there, but how do we balance this out with what the impact of doing that is? I mean, you're seeing it play out in I haven't fully read all the deeper on the headline, but cities in Arizona not getting water is a big problem.
Yeah, absolutely. And it's a risk that seems to only get bigger, and in terms of not only the probabilities, but the actual damage caused.
That's right.
So, all right, we're gonna quickly launch the second poll here for the audience as we move into the final portion here, the final stretch, and I guess to just shift slightly here, so to avoid focusing only on doom and gloom, as there are many strengths and not only risks in the CRE space, what I would pose to the panelists is, what do you see as some of the most convincing elements or characteristics that continue to make commercial real estate an attractive long-term investment? And so I guess, Sarah, I'll start with you here. Yeah, I know it's a broad question, but answer it as you please.
Well, I think first off, you can continue to get outsized performance in real estate, which makes it attractive. I think the fact that your collateral is something you can literally kick the tires on. You can see it, you can manipulate it. You can have a building that's been in existence for 100 years and is still, a Class A building if it's properly taken care of. I mean, to me, real estate is the most interesting and exciting of all the asset classes. So it's a little like, I'm always like, well, why would you not invest in real estate? It's like, it's the best. So it's a little tougher. But I think that, look, we continue to be able to deliver returns. You can do it in a way that is thoughtful. There's long-term stability in the assets. And, the other thing is, real estate is just a lot more interesting than stocks and bonds. Like, one of the problems with real estate is sometimes you tend to fall in love with the asset, and so you have to continue to remind yourself you can't do that. And nobody ever looks at a stock and it's like, oh, I never want to get that. So I think that we have a lot of work cut out for us over the next, 18 to 24 months. But I think that, Leslie and I were talking about, we both cut our teeth in very rough markets, but it was transformational and you learn so much. And so particularly people are just starting their careers, I would say, this is the point where you can really learn so much and really define what it is and why you're good at real estate. And I would put a big plug in at Leslie and I were talking about Scott Asset Management. This is, anybody can make money when it's a rising tide. Now you really have to focus on driving the fundamentals, understanding what your clients want, understanding what the tenants want, and figuring out a way to deliver that in a way that makes money.
That makes sense. And Leslie, I guess from the asset management perspective, what are some of the strengths that you see, whether it's in your portfolio or across the industry?
No, I think just going back to the basic fundamentals and believing in those long-term convictions that you started out, 20 plus years ago when I started out. Believe in those, believe in the demand drivers, understand those drivers, the locations of the real estate, what needs to be done, the bricks and sticks of it, and really you'll do fine with those types of assets that you really believe in, as Sarah mentioned too. There will be some that you'll have to sell that, time is money and time is value and that don't fit into your long-term strategies. And I think firms like us are going to be looking to sell those for reasons. Someone mentioned to me, sell the one asset to save the 9. you know, you're going to see a lot of that happening this year too. But there are exciting things with technology, infrastructure, ESG, that would create segments of opportunity that maybe wouldn't be so reliant on cycles that we're in right now. So just trying to add some positive spin to it.
And Robbie?
Yeah, and then do I look at as well, right? When you invest in private real estate, you have access to expertise, right? So basically the people that same as what Leslie and Sarah indicated, hey, technology, what technology implemented, how is that impacting the cash flow? How do I reduce expenses, right? So that is part of what people buy, right? So when you invest in private real estate, you get access to the expertise of people, as what Sarah Leslie indicated, based on the previous history, based on the experience, is in there. It's embedded into the NAV. It's embedded into the cash flow that people get, right? So, and right now as well compared to before, there's a lot more transparency on the data, right? So there's not a lot of data before. Now you get more and more data, and then this data have been utilized by the client and appraiser, right? So from the appraisal side, it's more communication to basically making sure the value are more up to date, based on reflecting of kind of information out there. For client perspective, is to identify, like I said, they indicate which one to work. Like how do I use it? How do I work with government? How do I address issue on climate, on affordability, and basically how do I create efficiency for that asset that then eventually get back to the investor, to the private real estate, right? So that's how I kind of look at that. I'm excited for private real estate just because there's a lot more stuff in there. And even ourselves in Altus, Omar, right? As you can see, with Reonomy acquisition, with Stratton acquisition, there's a lot more being done on it, right? So there's a lot of more analysis on it. The client do the same thing, right? So that's really exciting, right? So agree, compared to stock and bond, we may be behind in terms of using that technology on it, but it's there, right? So it's coming, and it's a lot of cases already in there. Investors just didn't realize that they're getting it within the cash flow. So.
Yeah, and I know that there's been some, I'll call it scuttle, I guess, about, you know, the return of real yield, right? And across the fixed income space, and that being potentially a detractor from CRE. However, I think the asset class being as big as it is, right, is not going to be replaced by some higher yielding securities. Their capital, and it has this element that is certainly more stable, but still has the ability to generate cash flow. And so at least from my perspective, and please, anybody here can call me out and tell me I'm wrong, and I value your opinions, but I do think that there are a lot of, at least just from a broad investable asset class, it still has some, I would say, unique characteristics that are quite attractive for capital allocators. And so I guess we're approaching at the end of our time, and I'd like to take these last few minutes to thank our panelists for joining today and for sharing your views. Sarah, Leslie, Robbie, thank you. And thanks to Michael, I know he's not on the screen, but for his earlier presentation and that teed up the great discussion. And finally, thank you to those who tuned in. A quick reminder, I think it was sent in the chat. You can sign up for the NCREIF Odyssey results review with Robbie and Phil Tiley that will in the coming weeks. So you can register there. But then with that, I will give everybody back a few minutes. So thanks again to our panelists, and until next time, take care.
Thank you.
Thank you.